Welcome to the program which puts you in touch with the best and brightest minds in the business. Yes, I'm Peter Switzer, and on tonight's show we'll get market watcher James Dunn's take on reporting season, and he'll pass judgment on Woolies versus Wesfarmers. Which one is the best buy right now? We'll try to get a clearer understanding on the global and local economic big pictures with Dr. John Newsom. Grant Shoebridge will explain why a federal court got it right in upholding the right of companies to patent jeans, and I'm not talking about denim jeans here. And we'll don the wellies to look at a pair of small business owners who have owned their own blockbuster television show when we examine the village vets, Dr. James Carroll and Dr. Anthony Bennett. Stay with us for the next hour and we'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to switzer@switzer.com.au. And you can follow me on Twitter, and the handle is @PeterSwitzer. But with the bulk of reporting season done and dusted, we are joined by James Dunn in Melbourne to give us his assessment, and he'll pass judgment on whether Woolies or Wesfarmers are the companies you should go long on. James, thanks for joining us.
Good evening, Peter.
You must love company reporting season, James. It gives you such relevance.
Well, not as much as the analysts love it, Peter. The spreadsheets get their computers are smoking as they tweak their spreadsheets. They don't see their wives and children or husbands for quite a few weeks, and they have relevance overload, Peter. It's far more for them than people like me, but it's a very, very busy season these days, and in fact, I think the analysts struggle to get to all the presentations. So many more of them these days on the net where they have to be, and really a lot of companies unable to attract much attention because, quite simply, the cream of the analyst crop are going to bigger companies. So absolute torrent, and of course, Peter, the traditional last-minute rush, which did see a few laggards not manage to make it out in time.
Okay, so James, just a big picture view. What are you saying about the calibre of reporting season?
Look, it was fairly good. It didn't shoot the lights out. We've got about 10%, 11% growth across the market. And the resources were very strong in the first half of the year. I think they were running at about up 40% on average resources earnings in the first half of the year, but you had that slump in commodity prices which brought that growth in the resource profits unavoidably down, although BHP and Rio Tinto were two of the big surprise or impressive results, Peter, or Rio only reporting half year, but they were very strong. But of course, the resources had been holding up the overall market earnings growth in recent reporting seasons, but we're just starting to see the strength come out of that, obviously because of the commodity prices coming down. Although it should be said that the resources companies now, not having obviously elevated super resources commodity prices, Peter, they're just dealing with okay ones in terms of their margins. So now the market's been a bit worried about that. But if you look at the big miners like BHP and Rio Tinto, Rio probably producing iron ore for less than BHP is. They're somewhere around $25. BHP's a bit higher. Then you've got Gina, Roy Hill's going to come in at about 40. You've got those companies, even at $85 iron ore prices, Peter, they're still making lots of money.
Okay, let's go to the banks now, because we know at the beginning of the year everyone was just sort of trying to turn people off the banks, but how do they report?
Well, they reported fairly well, and just the banks, I think, are the poster child for one of the real standouts for our reporting season, Peter, which was just the torrent of dividend largesse, the payout ratios on those banks. The market as a whole, you've got 69% average payout ratio in terms of the proportion of profit that goes out as dividends. It's just massive. And the banks are running higher than that, around 70 to 80%. And compare that to the US, Peter, where I think their payout ratio is running at 39%, and that's almost a record high for them. So investors should understand that the Australian market is a bit of an anomaly in world share markets in terms of the proportion of the profit that companies earn that's pumped out as dividends. And of course, we've spoken about this before, Peter, you and I, that it's this demand for yield on the part of the self-managed super funds, which own about 16 to 18% of the stock market now, and it's affecting company behaviour. No companies want to lower their dividend payout ratio, and we've got people even like Reserve Bank Governor Glenn Stevens saying, look, is this right for the rest of the economy that Australian companies pay out so much of their profits to their investors in terms of dividends? Shouldn't they be reinvesting some more, a larger proportion of that? And I think that's a debate the Australian capital market has to have.
But James, don't you think a part of this also is, okay, the housing market is starting to do well. We had at least a good year to a year and a half. But banks aren't really going gangbusters on the revenue side, are they? They're really making a lot of their profits by cutting their costs. So, in a sense, this is like a holding pattern for the banks. It may well be there could be a couple of years as interest rates rise and maybe the economy is growing at 3.5% or 4% somewhere down the track. The banks actually will be making a lot of money on the top side, and that's when they won't have to really appeal to dividend players.
Well, that's right, and I mean, people look at the bank profits in Australia and just wonder how much longer can it go on? How much longer can they cannibalise each other? And in this economy, although some of them have overseas businesses, of course, but Australia and just the economy and the, well, can we call them a cartel of the four big banks or four big oligarchs of the banking sector, Peter? They're just massively profitable. And as you say, they've achieved a lot of that through cost cutting. And really, just to step back a little bit, Peter, that's another factor from reporting season that we should mention, and that is that revenue growth on the top line was still, it's about the third reporting season in a row, third or fourth, that revenue growth's been very difficult to come by, and really Australian companies, and the banks are at the forefront of this, have achieved better profits by cost cutting, but at some point they've got to, investors and the market in terms of share prices have got to see some genuine revenue growth coming through for Australian companies. But back to the banks, they're just such massive generators of cash, and look, a lot of it through fee income and the net interest margin. So you've got a proportion of profits going out to shareholders as dividends that is just massive. Will that come under pressure as interest rates start to rise? I don't think so, because they manage that. They manage both sides of their book perfectly well, and the point is that they do well in both a rising and low interest rate environment. It used to be not thought of that way, that one part of it was better for banks, but they've managed to demonstrate they're pretty flexible, Peter, on how they earn money.
Yep. Let's go industrials as a group. What was your overall feeling about how industrials did?
Well, again, it came in pretty much on expectations, but did not shoot the lights out. And for industrials, even more than the banks, that's where this failure to boost revenue really strongly was very evident. And cost cutting is a major part of producing profits, but at some point we've got to get the famed consumer spending in Australia to really start kicking along, so that our industrial companies can generate revenue growth on the top line. It's needed. And look, we said this last year, I think, Peter, after reporting season, that we hoped to see strong revenue growth for the 2013-14 financial year. We really didn't see that. We still saw a reasonable profit growth because of further cost cutting and efficiencies, and they're getting a dividend from better use of technology. But that can't go on without top line, as in revenue growth. And so hopefully it's financial year 14-15 where we start to see that. Yeah,
for sure. Now, one last thing. You recently wrote a story for the Switzer Super Report on Wesfarmers versus Woolworths. So what do you reckon? If someone is in neither company now, which one would you recommend they go into?
Well, I just think, as I said in the article, you've got they're very close on most of their metrics, Peter, and just for the minute, forget that Wesfarmers has some other businesses as a conglomerate. It is effectively a retailer with somewhere around 85–90% of its business coming from its massive retail operations. So let's compare them, and they're not exactly apples and apples, but I just think on the projected yields, and that's how we always look at stocks primarily for the Switzer Super Report, because self-managed super fund investors are very, very interested in yield.
Yep.
Just on that, that's really the only metric where there's a very clear difference, and that is Wesfarmers with more than a percentage point benefit in terms of expected dividend yield. So just on that basis, after weighing the fact that they do have their problem childs, obviously for Woolworths, it's Masters, and look, they've got issues in some of their businesses. Target was a struggle for Wesfarmers, but it's just that yield basis that Wesfarmers is pulling a percentage point or more better yield out of its businesses. That's the only reason I could really find to say that's where a yield-oriented investor should probably look more so than Woolworths.
James, thanks for joining us, mate.
Thanks, Peter.
So, coming up after the break, Dr. John Houston on the big economic picture that could determine what happens to your investments over the next 12 months.